S&P Global is now down by 5.5% in the last year, down about 3.3% year to date, and in the last month alone, they're now down nearly 11%. Now, this is a big deal for a stock like S&P Global because we're talking about a very high quality stock, a company that has been growing dividends consecutively for over 50 years. Now, we hear the term high quality thrown around a lot, but what does that actually mean? Well, in my opinion, it means the company's able to do things like generate high levels of return on invested capital. It typically means that they have high levels of profitability. And ideally, it's a capital-light business that can convert a lot of its revenue into free cash flow. And along with all of this, the company should have a high level of predictability with its cash flows. And with all those things I just mentioned, I think S&P Global looks very attractive. So before we actually dive into the numbers, let's talk about what S&P Global actually does. And this was a company I was highlighting over on Dividendology.com just the other day. Every month I put out a list of undervalued dividend stocks, and you can sign up for free to get this at the link in the description, or alternatively, you could just scan the QR code that I'm putting on the screen right this very moment. Essentially, S&P Global provides essential financial infrastructure like credit ratings, market indices like the S&P 500, and data analytics. So they have four main business segments: S&P Global Ratings, S&P Dow Jones Indices, S&P Global Market Intelligence, and then they have Commodity Insights and Engineering Solutions. Each of these business segments is very capital light, and the company is also diversified with its business segments. So if we jump over to our dividend breakdown sheet, here's what you'll notice. Free cash flow over the last decade has grown at an incredible rate. 2014 free cash flow was about $1.1 billion, and in 2024, it was about $5.5 billion. So as a result of growing free cash flow at a high rate, in fact, a rate of about 17.42% on a compounded annual growth rate basis, the company has been growing their dividends at a high rate as well. We can see the 10-year dividend CAGR at about 11.12%. So a lot of the times when we talk about stocks that are dividend kings, they're more mature companies. Think about stocks like Coca-Cola and Pepsi and Johnson & Johnson. Yes, they've grown dividends for a long time, but they're not necessarily growing earnings and free cash flow at a very fast rate anymore, and dividends aren't growing at a fast rate. But that's not the case for SPGI. That's what's so impressive about this company. They've been able to grow their dividends at a high rate, while the free cash flow payout ratio stays very low at just 20.38%. Again, the key here is they're still growing free cash flow at a high rate. But when it comes to the free cash flow of SPGI, it's not just the growth rate that makes it so attractive. It's the predictability. Again, this is what I was highlighting over on Dividendology.com. But as of 2024, around 95.9% of the company's revenue was recurring in nature. 96% of revenue is recurring. So what does that mean for us as investors? We can feel extremely confident in the future revenue streams of the business. There's not going to be a lot of volatility with their revenue. So if we just look at the profitability sheet, look at this revenue charted out over the last decade. This is a thing of absolute beauty. Every single year, like clockwork, the revenue seems to be growing at a very healthy rate. They have a 5-year revenue CAGR of 16.23%. And on top of this, the company is incredibly capital light. In fact, if we take a deeper dive into their actual free cash flow metrics, let's go ahead and zoom in and take a closer look at the free cash flow margins. Now, we have to remember, free cash flow margin, this is an important metric that not a lot of people discuss. This essentially tells us for every $100 in revenue that the company generates, how much is actually becoming free cash flow. So for example, in 2024, SPGI had a free cash flow margin of 39.17%. So if they generated $100 in revenue, about $39.17 actually became free cash flow. Now, what do you notice about this company? Historically, they've had very high free cash flow margins, and it's quite a bit higher in 2024 than it was in the previous 2 years. So when you combine the fact that the company has been growing revenue at an incredibly fast rate with the fact that they have very high margins, you get a free cash flow generating machine. And again, as a result of growing free cash flow, the company has a multitude of options, and one of those being to continue to pay and grow those dividends. So naturally, what's happened as a result of all these quality metrics for SPGI, the predictable revenue streams, the high free cash flow margins, the company has historically traded at a premium. That certainly should not come as a surprise. People love paying extra for predictability, But what we can see with S&P Global, if we look at that price to earnings ratio over the last year, it's continued to climb lower. Now, pretty much at its lowest PE multiple for the trailing 12 months in the last year, with the exception of the tariff scare. So we need to dig into what's going on with the company. What's the reason for the sell-off? Now, to start, we can see the last time they reported earnings was all the way back on July 31st, which feels like a long time ago in the market, but we can see they actually beat on top and bottom lines, and there was also other good news revealed during that time. The company increased their revenue guidance for the year, and they also increased their guidance for earnings per share. On top of this, they also noted how they were looking to advance AI-driven product innovation. Now, that wasn't the reason for the sell-off. In fact, we can see the stock actually performed quite well during the time period when they released earnings. But what happened more recently was a poor earnings report from one of their competitors, FactSet. FactSet released their earnings report, which didn't meet expectations, and on top of this, they issued softer than desired fiscal year 2026 revenue guidance. The market didn't like the sound of S&P Global's competitors not doing well and issuing soft guidance, so this started the sell-off for the stock, and it was somewhat significant, going from around $544 per share in just a few days all the way down to about $484, and we've seen the sell-off continue slightly, now trading at about $481. So how does this actually impact the company's valuation? Well, if we look at the forward-looking valuation, we can see right here a price to earnings ratio of about 27.71. Now, compared to their 5-year average, which is sitting at about 30.79, that's about 10% lower. If we look at this on a trailing 12 months basis, it's about 8.6% lower. So right away, we can see the company is trading below its historic averages, but let's not just stop there. Let's actually dive into these valuations just a little bit more. We'll plug in SPGI, and let's just start by looking at our discounted cash flow analysis model for this company. Now again, all we're doing is we're basically projecting how much free cash flow the company will produce in the future, so we can estimate what the company is actually worth. And there's a few different things to take into consideration, such as historical free cash flow growth. What does the industry expect? What are analysts projecting? The reason we have to ask ourselves these questions is we need to project a growth rate to the future free cash flows for the company. Now, at the moment, if we look at earnings expectations from analysts, we can see they're typically projecting around 10 to around 12% growth when it comes to earnings over the next few years. If we look at ticker data estimates for the exact same thing, down here, we can see essentially the same thing, around 11% projected EPS growth through the next few years. So let's just assume those average analyst expectations of around 11%, which again, to keep in mind, that's actually a little bit lower than what we've historically seen. If the company can achieve 11% free cash flow growth, and we apply that to the future free cash flows, find the present value of those future free cash flows and add them together, add the company's cash and cash equivalents, subtract out total debt to get equity value, and divide by shares outstanding, we come to what looks like a fair value of about $502.55, which is only about 4 to 5% higher actually than that current share price. Now, I know what you might be thinking, that doesn't seem like a lot of upside for a stock that's seen a somewhat decent sell-off in the last month, close to 11%. But here's what you're certainly missing if that's your thought process. Investors are always willing to pay a premium for quality. The question we have to ask is, how much of a premium are we willing to pay? For a stock like S&P Global, where 96% of their revenues are recurring in nature, there's no doubt that for me personally, I am willing to pay a slight premium because I can feel confident in the future cash flows of the business, and as a result, I know they're going to be able to grow those dividends at a healthy rate and pay them at a healthy rate in the future. But let's not just stop there. Let's talk about what type of returns we can actually see from S&P Global in the future. If they achieve 11% earnings growth through the year 2030, and then let's just assume an even lower PE ratio than what they've traded at in the trailing 12 months. Maybe it drops down from about 36 for the trailing 12 months all the way down to 30, which is also below the average over the last decade. You can still see from around 2027 through 2030, you'd be looking at double-digit returns, and that's not including the dividend. So when I look at a company like S&P Global right now, I absolutely think that this is a stock that has some opportunity. Could the sell-off continue over the next few months? Absolutely, it certainly could. But what would be beautiful about that is the fact that that sell-off would be strictly due to multiple contraction. Investors wanting to pay a lower PE ratio for this stock, because from what we're seeing, it's extremely likely that revenues are going to at least continue to grow at a slow rate at a bare minimum. So revenue, free cash flow, earnings, and dividends are all going to continue to grow. So in my opinion, if the sell-off continues, I completely welcome that. I think that would be great news for investors if this sell-off continues. And before we conclude, I do want to quickly mention that they just announced they're launching a new crypto ecosystem index. Basically, they stated they plan to expand its crypto index offerings with the launch of the S&P Digital Markets 50 Index. So go ahead and let me know what you think of SPGI in the comments down below, if you think it's trading at an interesting valuation, if you plan on buying or selling. And again, be sure to check out dividendology.com at the link in the description, or you can just scan the QR code that's on the screen right now. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.